Welcome to today's video, where we tackle a classic money dilemma. If you have low-interest consumer debt around 4%, should you pay it off now or keep investing? We'll break down the math, the emotions, the taxes, and the strategy so you can make an informed choice. Let's move from high-level context into a practical roadmap you can act on right away. To begin, let's set the stage. We're focusing on relatively low-interest consumer or personal debt, roughly around 4%, and comparing that with the historically higher returns of diversified stock market investments. The decision isn't just about numbers. It's also about risk tolerance, stress management, and tax implications. With that context, let's outline what we'll cover so you can follow along. Next, here's our roadmap. We'll start with the core debate and a decision flow. Then we'll examine the mathematical case for continuing to invest, followed by the emotional case for paying off debt to gain peace of mind. After that, we'll propose a hybrid plan that accelerates payoff without liquidating investments. We'll then cover taxes and common pitfalls, especially around loan forgiveness programs. Finally, we'll test your understanding with quick quizzes and wrap up with key takeaways and next steps. Before we dive deeper, a quick but important disclaimer. This video is for educational purposes only and does not constitute financial, tax, or legal advice. Everyone's situation is unique, so please consult a qualified professional who can evaluate your specific circumstances before making decisions. Moving on, here's a decision map that frames your options. If your priority is the mathematical expectation of higher long-run returns, you'll likely keep investing while making at least the minimum payments on your low-interest debt. If your priority is emotional relief and certainty, you'll likely accelerate debt payoff. A blended strategy can split cash flow between both goals. Critically, consider taxes and avoid selling appreciated investments unnecessarily to prevent capital gains taxes and lost compounding. Revisit your choice as your income and comfort level change. Now, from a purely financial perspective, the case for investing is straightforward. Historically, broad stock market returns tend to exceed 4% over long periods, so directing more money toward investments could create higher long-term wealth than paying off low-cost debt faster. That said, markets are volatile and nothing is guaranteed. Using dollar-cost averaging into low-cost, diversified index funds can smooth the ride and maintain discipline. As a simple rule of thumb, if your expected after-tax investment return is greater than your debt's interest rate, investing usually wins in the long term. Still, recognize the uncertainty and your own risk tolerance. Meanwhile, let's compare the two approaches. Keeping investments growing can preserve liquidity and compounding, and it effectively uses low-interest debt as cheap leverage. However, it requires emotional resilience during market downturns. Paying off debt, by contrast, gives a guaranteed return equal to the interest rate and reduces financial stress, improving cash flow sooner. The trade-off is the possibility of missing higher market gains if the market performs well during the payoff period. Your comfort with risk and volatility is central to choosing. Next, consider the emotional side. Many people value certainty more than probabilistic returns. Carrying debt, even at a low rate, can feel like a constant weight. Eliminating it can reduce mental bandwidth spent worrying about balances and due dates, which is valuable on its own. If sleeping well at night matters most to you, the psychological benefit may justify prioritizing debt freedom. Remember, personal finance is personal. Your mental well-being and life context deserve front and center attention. Now let's bridge the two worlds with a hybrid plan. First, build or maintain an emergency fund so that an unexpected expense doesn't push you into higher cost debt. Continue automatic investing, especially in tax-advantaged accounts, while making minimum payments on your low-rate debt. Then direct raises, bonuses, and windfalls toward principal payments to accelerate payoff without liquidating your portfolio. This avoids triggering capital gains taxes and preserves your compounding engine. Revisit and adjust your split every 6 to 12 months as your income and goals change. Here's a pie-style visualization of a sample hybrid split. 10% for the required minimum debt payment, 40% as additional principal toward the debt, and 50% allocated to investing. This is just an example. Your split should reflect your risk tolerance, time horizon, and cash flow needs. The point is that you can accelerate debt payoff meaningfully while still letting investments compound. Continuing, taxes can flip the math. If you sell appreciated investments to pay down a 4% loan, you may owe capital gains taxes today, reducing your net payoff benefit. You also give up future compounding on those shares. That's why using new cash flow, like bonuses and raises, is often preferable to liquidating investments. Always consider account type, holding period, and your tax bracket before selling. The goal is to improve your net position, not just reduce a balance. Now let's look at a 5-year path. On one track, your debt balance trends downward, with minimum payments plus extra principal funded by raises and bonuses. You'll see milestones where interest savings accumulate as the balance falls. On the other track, your investment account grows with steady contributions and market returns, albeit with normal volatility. Around year 3, the plan ramps up after a promotion, accelerating payoff further. This timeline shows how both goals can progress together rather than being mutually exclusive. Shifting to student loan strategies. Be cautious with forgiveness programs tied to income-driven repayment. If your income is set to rise quickly, your required payments may increase enough that you fully repay the loan before the forgiveness milestone. In that case, you receive no benefit and could feel locked into a job for no reason. The remedy is to model your expected income path and projected payments before committing to a long-term plan. Make sure the math supports the strategy. Question 1. With a 4% fixed-rate debt and an expected long-term after-tax market return above 4%, which approach is typically favored by pure financial math? Options. A. Aggressively pay off the 4% debt first. B. Keep investing while making minimum payments. C. Stop investing and build a larger emergency fund only. D. Liquidate all investments to immediately pay off debt. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Keep investing while making minimum payments. Historically, diversified market returns have tended to exceed 4%, so the expected value calculation often points to continuing to invest. Remember, this is not guaranteed, and the emotional and risk management aspects can still justify paying off the debt faster for many people. Question 2. When can loan forgiveness tied to income-driven repayment be less beneficial than it appears? Options. A. When income is flat or declining. B. When income is projected to rise rapidly, driving payments up. C. When interest rates on the loan are above 10%. D. When you have no raises for a decade. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. When your income is projected to rise rapidly. In that case, income-driven payments may increase significantly, leading you to repay the loan before you reach the forgiveness milestone. This eliminates the expected benefit and may leave you feeling tied to a specific job unnecessarily. As we recap, the math often favors continuing to invest when debt is around 4%. But markets are uncertain, and that advantage isn't guaranteed. Your peace of mind and stress level are legitimate reasons to prioritize paying off debt. A practical hybrid approach is to keep investing while using raises and bonuses to accelerate principal payments, avoiding unnecessary capital gains taxes. Finally, model income-driven repayment carefully against your expected income growth to avoid relying on forgiveness that never materializes. Here is a quick scenario snapshot. The invest-first approach means making minimum payments on the debt and investing the rest, aiming for higher expected long-term growth but accepting market volatility. The pay debt first approach channels extra cash to principal, delivering a guaranteed return equal to the interest rate and valuable stress reduction, though you may miss market upside. The hybrid split preserves compounding while still accelerating payoff using new cash flow, and it requires periodic recalibration. In summary, start by clarifying whether you prioritize expected growth or certainty. If you're unsure, adopt a hybrid split and revisit it every 6 to 12 months. 3. Protect your compounding machine by avoiding unnecessary sales that trigger taxes. Carefully compare projected income-driven payments to your expected income growth before banking on forgiveness. Ultimately, align your money strategy with your values, stress tolerance, and time horizon. As we close, thank you for watching. If you found this helpful, please like the video, share it with someone who's deciding between investing and paying off debt, and subscribe for more practical, research-backed money content. Drop your thoughts and strategies in the comments. Do you lean toward investing, paying off, or a blend? I'd love to hear your approach and why.